Everybody. Wow, I'm live. This is great. I'm Barnett Sherman. I'm very grateful for the two Matts, Matt Smith, Matt Gerstenfeld, for inviting me here to host and moderate this. Could not think of a more exciting event. If you think about the municipal bond market and what we do, let's put it in practical terms. Every day, about 50 million students go to a public school across America. There's roughly 26 million admissions to nonprofit and state and local hospitals across the country. People are driving over 3,263 billion vehicle miles across roads. Thousands of people are turning on their water. Millions of people are flipping the switch for electricity. And the reason they can do that is because what? And now my voice is back. Yes, we're all good. It's what we do in this market. That is the power of the municipal bond market. It's not just $4 trillion. It's not just $400 billion in issuance, give or take, every year. It's the actual outcome and impact this has on our communities every single day. And every one of us here are part of that and responsible for that in large degree. And no matter what capacity you're doing it. This also has to be one of the greatest times in the municipal bond market because finally, I can say there's a personal opinion, technology is coming into the market faster and faster than it ever has previously. The market is being transformed in real time, and all of you here are doing that. That's why you're here. It's why you have colleagues back at your shops for doing this. They're all transforming this market. It is a once-in-a-career lifetime opportunity, in my personal opinion. Where else do you get to do that in the market and get to be such a key part of doing that? I can't think of another place. You're calling me off already? No? Just kidding. So with that, I think we have couple of housekeeping items. One, please turn your phones off. I know it's urgent and essential that you be in contact with your digital monitor at all times, but unless you have a parole officer calling you, and that may only count for one or two of you. Sorry. Please turn the phones off. And also we have for Q&A, is that coming up, Matt, for Slido? We're actually using technology for Q&A. How cool is this? So if you have a question, join Slido, punch in the number, punch in your question. I get to look at it. I'm judge, juror, and executioner, so maybe we'll let it up, maybe not. Well, we're going to, don't worry about it. For our first panel, buy-side folks, because I want to get right into this. Justin Land, CEO of AG Analytics. Manju Boraiah, did I get that right? Pretty close. Thank you. Allspring, and Hector Negroni from Foundation Credit. So let's dig right in. I feel like I'm on a TV set. Doesn't it feel like I'm on a TV set? That old Seinfeld episode, remember the one where he said what was it, the Dick Cavett show? No, anyway. All right. 45 minutes, questions that will likely take a lot longer to answer. My only request is you think about not just what you're doing, but why you're doing it. What's the outcome you want in this? What are we looking for? What's the next you're doing this for in the market to move the market forward? What technology is working for you? What do you wish you had? What's the next, and what's the next from that in transforming it? So what metrics are driving portfolio optimization? Which one of you wants to jump in on that? Go ahead.
Well, I can jump in. Yeah, so from our perspective, Barnett, so, I'm coming from the SMA perspective here. So we run one of the largest Muni SMA business. Are you guys able to hear me? Okay. So from our perspective, we focus on kind of two things when it comes to Muni SMAs, like customization and tax management, which is really kind of the key driver of growth these days in the wealth space. So for us, when we're creating portfolios, we've kind of built a systematic engine to do that in the Muni space. And we are focused on, in the retail client, they're looking at customizing duration exposures, credit quality, Obviously, state preference and state specificity is actually still a key piece on the Muni space. But that's really kind of what's driving our optimization engine, right? And then when you come to tax management, this concept of systematic tax loss harvesting, which I don't know, some of you guys might be familiar with, the notion is when there are losses, you harvest them, and then you reinvest the proceeds in another QSIP and kind of book those losses and kind of try to maximize the after gain returns for investors. So that's really kind of what we built. That is really what's resonating in the industry these days, especially in the fixed income, because the concept of direct indexing on the equities, when you take that to fixed income, it's really laddered portfolios in munis and taxable fixed income, and doing it in a scalable fashion with customization on top of that. So that's really, from my perspective, that's what we're seeing in the marketplace.
I'd only say that that's an important thing to think about if you pull the lens back a little bit, which is what he's really referring to is what we know as the bread and butter of our business, which is originating tax-exempt product to be distributed primarily to end users who have arms and legs and pay tax in the United States. And there's absolutely nothing wrong with that. But it's only one dimension of how a portfolio might be optimized, because you're only solving for that one client base. What we think about it differently, and we maybe are a little bit outside that system, is we're solving for absolute return. Our job is to think about how to optimize that portfolio with respect not to taxes necessarily, but to outright performance. Now that's I'm the alts. I get paid for performance. There's incentive fees in my funds. That's why we prioritize that. I just think right now that the effort around technology, rightly so, is very focused on addressing a dominant retail influence in our marketplace. I think when you think about the next frontiers, if there's one big, next step for technology to take in our place, it's how it makes decisions around performance. Not performance in a more narrow focus of optimizing the tax constraints or credit constraints, but actually like more of an unbounded, unconstrained performance profile. I think if we've been in the business, I've been in the business for 1,000 years now. If you've been in the business long enough, the inefficiency is rich and frequent enough. There's lots more to do than,
And I think on top of that, Hector, you're right. I divide the market into, and again, nothing wrong with it. People need both, but I look at it kind of in the view of where the equity market's gotten to is you have beta products, and the goal of a beta product is exposure and very low fees. And technology plays very well into creating beta products with low fees. On the flip side, you have alpha products like what Hector does and other opportunity funds out there. Technology works in a very different way. And I think we need to look at that lens of, are we building for a particular company or group of people? Are we building a beta product and it's really about expenses? Or are we building an alpha product, which is about outperformance versus whatever benchmark? And I want to thank the two Matts while I'm here for having this, because I came last year and my partner Abhishek Loto, which you can meet, he said today, the thing I like about this conference is this is a conference about execution and how we move forward. This is not a conference about, let's talk about, this legislative policy will be better or worse for munis. And I think that should be the focus today of how do we talk about executing better in the future in our industry.
So good, I'll take you up on that. Because that's the next question. So he put his foot right in, right? So to what extent has execution automation become relevant to the success of your business, or are there still friction points? This is for anybody. Is there a reduced need for manual execution? And I think it follows, the next question was, how has liquidity changed over the last few years, and what opportunities has it opened or closed for you? Because I don't think you can really talk about execution without talking about liquidity and how it's been improved or not. You want to?
Sure, yeah.
Sure, thanks.
I mean, it's super critical for us, Barnett. So like I came from the hedge fund world, so I came from the world where we could execute in seconds and minutes to the Muni business is quite different, right? So days actually. So so it was a shocker for me. So so I have two roles in my current job. So I manage the institutional mandates on the systematic fixed income business and also the custom SMA business. So here, For wealth investors, especially in munis, it's the time to invest. So when you measure time to invest, you're measuring it in days. And it took me a while to understand why that's the case. Like even in like when you're loading up on national ladders, it takes like 20 days sometimes to find the bonds and like ladder up across the curve. In state preference or state specific portfolios, it can take like 30 to 60 days. Our disclosure says 30 to 60 days, right? So that was a shocker. It does take a long time, right? So from our perspective, especially when the rates are so high, the investors are really kind of like critical about the cash drag, right? So if the cash is sitting and you're not able to invest that, it leads to more conversations. So we are trying to minimize that, right? We want to basically get to a point where we can systematically trade munis and kind of get better liquidity for our clients. So that's what we're working towards. In the taxable fixed income space, we have done it, right? So we get the inventories, we automatically build portfolios on the fly, and then execute that in days, less than 3 days. But munis is one area where it's been harder. But that's really for us. That's really the next phase of innovation. Get that to a place where you can do that in less than a week.
And I think with that,
Yeah.
we need everybody in this room and everybody outside this room, because you can't have a market without other market participants. If we want to get from 60 days down to 3 days, we need trading volume, we need liquidity, we need price transparency, we need not 4-hour firm times. All those things are super important. And again, I go back to, I look at the equity market. It's highly efficient. There's price transparency. You can trade as much or as little as you want very cheaply. We need all market participants to think like that. And it ends up being better for the end client. They're invested in 3 days instead of two months. And that is where technology will help us, because we're in a non-homogeneous world. We have 1.3 million CUSIPs versus 6,000 or 7,000 equities with all these different attributes and tax characteristics. But it needs to be a market thing. It can't just be one person leading the way, because even if they have the best tech and nobody trades like that, it doesn't matter.
I'm probably the greatest Luddite in the room. Our technology use is very narrow and very specific, and not like probably a lot of others in the room. But I encourage everybody to kind of, again, look for those frontiers. And what we're really saying, in some ways, all of us, is, the opportunity comes from what is really unique market structure. If you've ever heard me talk about the marketplace, what makes us so different is, if we had been tasked by the federal government to come up with a means by which raised capital was formed for essential services and infrastructure, the last thing we'd walk out with is what we have. Right? It's just really not. It's super inefficient. It's organic. It's like weeds growing in the cracks. And so, the idea of where technology is the most meaningful is something I think a lot about. It's not meaningful to me at the moment right now, where it's mostly being created, because I don't have a dependency along a retail client base for the most part. I'm not generally a deliverer of executive income. But when I think about where it's valuable, I think I said about alpha. I think like the new issue opportunity is enormous. We all have to like have a really hard discussion though, like to make new issue be more efficient and more applicable, we have to kill a couple thousand people who are, financial advisors, disclosure counsel, tax counsel, all who are deeply invested in no change. It's actually not really the issuers, it's all their advisors. And then lastly is this liquidity issue, which is, listen, we make most of our money because the block market doesn't trade anywhere electronically. We trade everything. We trade an average ticket size of probably $4 or $5 million a ticket, and it's all voice. And that's an opportunity that's just waiting for somebody to be addressed. I mean, yesterday, Goldman did a $6 billion portfolio trade in the corporate desk. And, and it was between life insurance companies. And I'm sure those insurance companies had munis. They were definitely not part of the portfolio trade because it can't be affected and scale. I think those are really interesting frontier opportunities that, those of you who want to build business and build solutions should be striving for.
Yeah, we might want to, at some point, touch base again on, these embedded incumbents who, are, in my mind, merchants of complexity and, adverse change. It's my 3 cents on this is that they're doomed because technology wins. And it may take a little bit longer for them to find alternative career choices. I'm not going to suggest we kill them, by the way.
Yeah.
But I can understand the heartfelt feeling about it. Let's shift gears just a little bit. I mean, let's talk about SMAs and SMA growth. What do you think, or what's your view as to what's driving these inflows? How has the growth of SMA and ETF assets, and just as a quick one, in 2021, SMA numbers vary depending on who you're asking, but in 2021, SMAs had, by some counts, 332 billion. By 2023, 494 billion, up about 48%. And ETFs had a similarly large climb, 83 billion in 21 to 122 billion in 23. That's pretty dramatic, and it obviously is far and above what market returns have been over that time. So the assets are pouring in from there. And just to add a little bit more perspective, mutual funds actually saw a 22% decline over that period from it's like $1,089,000,000 to 846 billion with that. So clearly some mutual fund money is going over to the ETFs and the SMA. What else do you see happening? How are you managing that? How are you managing investor expectations to get that money invested in along their mandates?
Yeah, no, I think we've kind of seen stellar growth in SMAs, Barnett. So if you look at the managed accounts industry rate, which is like, that's really what the wealth industry is, about 10 trillion. So I think you were probably referencing the Muni SMAs, but if you look at the overall SMAs, it's 2.5 trillion. So it's about 25% of the managed account space, projected to get to 3.5 in the next like 5 to 10 years. So massive growth, right? So what is happening is the mutual fund industry is really shrinking. It's a melting ice cube. If you look at the Muni mutual funds versus Muni SMAs, now Muni SMAs have actually outpaced Muni mutual funds. So that was interesting. That happened, I think, a year or two ago. What you've seen is obviously in Munis, I think like close to 60% of Munis is held by individual investors. And that's actually kind of what's leading the changes. These investors are now shifting from mutual funds to SMAs for two reasons. One is cost, right, fee, because SMAs are cheaper. And the other one is tax efficiency, right? It's more tax efficient to hold these individual bonds and then kind of harvest them for losses or potentially customize them. So we've seen a stellar growth. We've kind of shifted our strategy, in our firm as well. We are a mutual fund shop. We know that the mutual funds are going to shrink. They continue shrinking. So we've kind of shifted our efforts to kind of growing our SMA business. And the active ETFs is another one, right? So if you look at the three fastest growing verticals in the wealth space, it's alts, no doubt, and then active ETFs in general, and then SMAs. So for us, our kind of future really holds in being part of the change as opposed to kind of resisting it. And mutual funds are obviously kind of being kind of driven out of the picture. I don't think it's going to go away, right? When you talk to the RAs, like I talked to a lot of the advisors, what you see is they're basically shifting their asset allocation models. They're still allocating to mutual funds, but it's actually lesser and lesser these days. And tax efficiency and fees are essentially the two drivers from my perspective.
From my old career running SMA business, I think that the tax piece is where it's at. And mutual funds, you can't just pick this one bond that has a loss and take that loss. I think it's really as simple as that. When I started in the business in the 90s, you couldn't do that. The market was too inefficient. You had to have very large clients for SMAs, but now because of technology and everything else, it's not a big deal to run a $250,000 account or $500,000 account and be super tax efficient. So it's just, in my mind, it's always, what is the goal of the end investor? As a municipal bond investor, you want tax-free income and you want tax efficiency. So what's the cheapest vehicle to do it? For a long time, it was mutual funds. Now it's not. I think the rise of active ETFs is great. I know a guy two doors down who may have just launched an ETF, so I'll make a plug for that. But I think that's an important vehicle as well because people need sleeves that are not the kind of buy and hold sleeve of what an SMA is, but may need it for liquidity or other purposes beyond just I clip my coupons every 6 months.
Fantastic gratuitous lateral.
Yeah.
So
You're paying me for that.
Exactly.
right,
So I do think if I was in the mutual fund space, I remember when I first started, in the late 80s, early 90s, the mutual fund guys were discretionary. Like they made calls. There were some big name guys who made calls and they got paid on performance. Somewhere that radically changed. And mutual funds have become, not all of them, of course, but for a vast majority of them, some other version of an index. And worse, rather than owning a set of bonds where you know your duration, you can ask for duration, you can solve for it, which technology facilitates, you just own a perpetual duration. You always own a 20-year bond in the mutual funds. And well, that's great as long as the guy's making a call to do that. That's on purpose. And it's kind of accidental. So if I was in the mutual fund space, I'd be very fixated on developing an identity as a shot caller. I'd want to get paid for performance. I'd want you to come to my fund because my discretion affords you an outsized return. Because if you're not doing that, you're going to get eaten alive because it's getting cheaper and easier to build the portfolios for clients at scale. And we see it coming. Make no mistake, we're going where the puck is. Well, we're a private funds business. We did just launch an ETF 2 weeks ago, and it's the first active ETF in the muni space that I know of using any systematic strategy. And we'll see where that goes. I'm not sure anybody cares yet, right? I don't know that people want to buy performance in the public space yet, but it's an interesting exercise that we partner with the Simplify guys on. So I do think, in as much as you're going to exercise discretion, you have to earn that discretion. Otherwise, cede it to the efficiency of technology and cost.
Right. Yeah, that's true. I mean, there is another kind of product innovation that has happened in SMAs, right? So mutual funds, I mean, it's not truly dead. Like we've SMA structures where like 49% of the SMA could be a no-fee mutual fund where you can actually make active bets. The other 51% is like individual securities. So that's actually an interesting structure in my view, which is also gaining popularity, especially in the active fixed income space, because it's harder for you to, kind of not buy and hold, but generate alpha, right? So for that, you still need a mutual fund, but it's actually a vault where you have an SMA holding a mutual fund now.
I guess I have follow-up questions on this. Because there is this large amount of funds coming into both the ETF and the SMAs, and we know the ETFs are very low on fees. Come into an ETF, and we're seeing fee pressure in the SMAs. How are you going to apply technology to your management and to your administration and your operations to deal with the fee pressure that you're obviously experiencing?
Yeah, I mean, automation is kind of the name of the game, right? So when we launched our ladders 3.5 years ago, I think it was like 15 basis points for a Muni ladder. It dropped to 10. Now I think it's dropped to 7. We're still competing. We do book prices, like book pricing for certain clients, and it's even lower, right? So it's harder to actually, when you look at the break-even cost of running this business, it's really hard. So what we've tried to do is really automate away as much as we can, including execution, right? That's really where you still have to use like, traders to do that. So to me, I think that's where the evolution is going to happen. So client onboarding, client servicing, trading, those are still highly costly. So those functions need to be, to some extent, made more efficient and cost efficient. So I think that's where the innovation is. Also, what we are seeing is essentially one platform that can do more. So being able to do munis, taxable fixed income, equities, doing multi-asset SMAs, and managing them on one platform is also going to help reduce that cost.
How do you see? You mentioned earlier 30 to 60 days sometimes to fill it out, and you've got it in your disclosure. How do you see improving on that? How do you see improving the liquidity? We can identify bonds faster, right? Meet those mandates, or is it forcing you to streamline your mandates? Or it's like, well, we know we can't do this, or we're going to have to charge a lot more for it. We're not going to be competitive. What do we do to?
Yeah, I think the way to do that is to bring the inventory into the portfolio creation process, right? So right now what's happening is you build some kind of a theoretical portfolio based on characteristics, and then you're going out and trying to buy those characteristics to see what's available So that disconnect, I think some folks have already solved it. It's a solvable problem, but I think the challenge is there are structures in place or workflows in place where certain, like Muni trading was done in a certain way, where it's still seen as a skill. Maybe there is skill to your point, Hector. But
Not to
but
put anybody on the
Yeah,
spot.
yeah.
Go ahead.
so I think there is skill. I mean, but in the odd lot world, I don't think there's any skill. You really have to do it more efficiently. And 95% of all munis that are traded today are odd lots, like less than $1 million in size,
Right.
right? So I think that's where technology can play a role.
I'll go back to the original question, right? I mean,
Yeah, please.
there's only kind of three things you can really do. You can get paid for discretion and excess return.
Mhm.
You can improve efficiency,
Right.
lower costs, or you can create secret sauce. And you can do what you're trying to do, which is build a platform to create, a better, more homogenized, scalable way of addressing credit. Like, you have to have something else to do it, because otherwise, you should talk about what you're doing to make, because that's different than making the money or
Mhm.
executing on the money.
Yeah, well, that was actually my
Yeah,
that was my next
I
question.
think there's two things. So there's what I'm doing is building scalable credit solutions because I think there's this at many shops, not all. There's this disconnect that the credit analysts are over here and you have portfolio managers and traders over here and they're not friends or something. And there's not this great information flow. And if you can create seamless information of credit to trading to portfolio management, you have better portfolio outcomes, and that's it. However, we have 50,000 issuers, so an analyst cannot go up to a portfolio manager and say, "Here's the 300 credits I'm following, and this is what happened today to all of them," because that's information overload and nothing will ever get done. So however much you can automate that becomes really crucial. And I think the next piece, there's this tackling from the first ATSs, the market accesses, the TMCs, and others that took some of the execution away. We have portfolio optimization programs that have come out. Credit is the next evolution that needs to get integrated into portfolio management because all portfolio management has a credit component and it's too often siloed over here, and it creates risk either of not executing for upside or not executing and taking on downside. I think there's also this piece, and I've said it at other conferences, all of us in this room have to sometimes step away from our background as Muni people and throw it all in the garbage. And I think about where Matt Smith came from of Headlands is here are a bunch of guys that had no idea what the hell a Muni bond is. And now they have the biggest algorithmic trading firm on the street. And I think it's mostly because they didn't have this implicit bias of a Muni is supposed to trade like this, and a 3 coupon is supposed to trade like this, and a 4 with a 5-year call is supposed to trade like this. They just say, I have a math problem. How do I solve it? And this is one of the things I think as an industry we need to be more open to. And we were talking about it before we started. There are so many data sets out there that may be highly valuable to trading munis that we're not using because we've never used them. And we need platforms to say, maybe getting Zillow data will really help us determine property tax revenue in a county or a city. Or maybe getting Chase credit card data will give us better information on sales taxes in a given area. And now with AI and big data and LLMs and all these things that are way above my head, we need to be open to any data. If we can validate it to help us construct and trade portfolios better, we should add, even if it seems crazy.
Yeah, sometimes the Muni market reminds me of Broadway show Fiddler on the Roof. Why do we do it? Tradition.
Yep.
Okay. Another manager used to say, he was on the corporate side, he said the Muni market, he'd shake his head, he goes, guys, it's musical over here. I said, okay, enough with the Hollywood. In any event,
But you can't dismiss the unique market structure. So with the quantum of fragmentation, the inability to effectively short the beta, the the disproportionate demand that is passive
Mhm.
and long only and investment grade, not focused necessarily on absolute performance. Like the lag it takes with which decisions to get made by issuers to issue bonds or something like, and you can't ignore those factors. I mean, there's a reason your peers from other
Mhm.
markets in fixed income
Right.
haven't crawled over the wall and built a truly
Right.
alpha-driven
Mhm.
systematic strategy.
Right.
What we did is we made one that incorporated the realities of the muni market.
Right.
And so I thought that was really important. So I do think there's a balance there. We do need to,
Mhm.
challenge, or do we need to challenge orthodoxy? Without doubt. I started the new issuing market every time. That's usually where I start every conversation. Because we're just doing nothing to evolve that. But we have to accept that there are boundaries and limits by virtue of the unique structure of the marketplace.
Yeah, no, I agree. I mean, I think if you look at the default risk in investment grade muni bonds, it's close to zero, right? 0.09 or something like that. But there is massive dispersion in the yield, in any one of those tranches. And I think that's really driven by all the idiosyncrasies. To your point, it's highly fragmented. There's so many of these, like you got to like go into the covenants and like disclosures, and it's not just the rating and the state, it's the issuer that's actually driving that. It's all of these other idiosyncrasies that play a role. So if you can model that, and if you can actually use that to your advantage, right, that's great. But it hasn't been systematized yet. So to me, I see a huge opportunity there.
I couldn't agree more. I don't actually see the muni market as fragmented as everybody else is. I think a lot of the fragmentation has come in because of the usage, the way people have just gotten used to doing things, and it's created this fragmentation. But to my mind, it's not fragmented, it's just hugely disorganized, and it can be systematized. We're not going to see, the muni market is not going to become a commoditized market by any shape or form, but certainly using the AI tools and the statistical tools can help sort through, what are the diamonds, what is it that we need to be looking at that really add value, and not just in credit, but across the board. And what's the rest of this stuff here that we've always sort of looked at and relied on that candidly doesn't add it and can be completely ignored or not ignored, falls into smaller and smaller pieces. So when you look at it, you shift the perspective, so that the muni market becomes clearer, loses its opacity, and adds more liquidity and adds more return because you can trade it more with more liquidity.
Yeah, I'm given the analogies. The one I often make is the municipal market's like a car lot.
A new car lot or a used car lot?
Actually, I usually say used car lot. Most of my clients don't know the space very well. They're not U.S. or they're endowments and foundations or pensions. And so what I have to explain to them, because they often have a bias like, munis, we don't pay taxes. Why would we care? Or munis is where my money goes to sleep, or everything's like Puerto Rico. It's usually some extreme, right? And so, but I have to explain to them, and I say, listen, the way to think about it is the munis like a car lot, right? Viewed through one's lens, they're all cars. They have four wheels and an engine, and they'll go somewhere. Through another lens, they're all really different. They're yellow, they have different mileage on them, different, they have different characteristics and features. And you may or not care. You may not be able to process that. The data set around pricing is, that sticker ain't where it's traded. It's home negotiable. You don't know anything about where it traded this morning on the car. You don't know, backward-looking price ticker. And there's really not a lot of people who make markets on cars. They're just there. And you got to hope to negotiate them. That's a crude way of kind of understanding it. I think that's kind of your point. It's like the fragmentation is a little bit in the eye of the beholder. It really is how you come at the problem, whether you see that there's something that can be managed or whether it's overwhelming.
And I think you both brought up something important to the fragmentation, and I made this up years ago, so this is not an official term, but there's a ton of bias in the market and what I would call name ting. So we're in Chicago, and I would remember buying University of Chicago bonds and clients calling me up screaming at me because I bought bonds in Chicago. I'm like,
University of Chicago's financials have 0.00 to do with the city of Chicago, but they're like, you can't buy those from me. I'm like, wait, so I get extra yield for the same rating as buying it in New York or Florida, I'll take that all day long, and that still exists. There's alpha and bias by the end investor that, depending on your point in time, it was California, or it was Illinois, or it was name your state or sector or anything else. This is wholly bad. Nothing is wholly bad. When everybody says that, I kind of run towards it. It reminds me of in '09 when Moody's downgraded every Cal RDA to BA1. And I'm like, you're telling me every single RDA in the whole state is below investment grade? That's just money to be had. So I think there's that implicit bias by the end investor that can be actualized in performance.
Yeah, Hector's point is well taken. It does depend on your perspective. I mean, it strikes me when I hear this is that one perspective is, for those of us who have slight OCD issues, we'd like to see the market more. You can laugh, it's okay. Nobody? Okay.
Hold on.
It's a tough crowd. But if at one point you want to see things more organized, you want to see them more streamlined and more liquid. But on the other side, if you look at the muni market and all the broken pipes and all this misperceptions that somebody won't let you buy University of Chicago, it's like, oh baby, look how much money we can make on this. These people have no idea what they're doing. Well, that's not a bad thing either, for the record. How am I doing on time, by the way? I know we started a little late. I don't want to. We got about 5. But I don't see any questions coming in over the technology. Does anybody have any questions that they'd like to? Yeah, please go ahead.
Yeah. As an embedded advisor, what could I do to help you guys out, a little bit more? Because I happen to serve as bond disclosure counsel, and I'm always looking for ways to bring in more tech. But what is it that we can do?
Good question. All my kidding aside, I think the challenge is you have to want to embrace the change. You have to want to adopt the technology, and you have to convince your clients often that there's a value proposition in adopting the technology. That's hard. Like I remind people when I used to run the dealer business a while ago, our issuing clients, they're in the operations business, which has a zero tolerance for risk. They're not in the finance business. And so you've got to find a way to get them to understand that embracing the technology and adoption of it, which is an incredible barrier, has a value proposition without risk, or without significant risk, or that's tolerant of the risk. And I think that is a big deal. I think the tip of the spear is the financial advisor community, but they're going to get downstream resistance from, disclosure counsel, tax counsel, and others. But I think as an advisor, coaching your issuing clients into understanding that embracing these tools is efficient and effective. And I say that with full awareness of how many legions of people are going to be opposed to it, including some of the underwriters. But it's about showing leadership.
And I'll add on to that. I'm on the working group at the NFMA for the FDTA. I think a lot comes down to disclosure. I was just looking the other day. Disclosure times versus 10 years ago are a couple days higher. And a lot has technologically happened in 10 years. The more disclosure we have in any market, the better the liquidity, the more the volume turnover. And issuers, especially small issuers, in my opinion, need to realize that digitally providing information will make their bonds more valuable, not less. A big mutual fund is not going to look at a $3 million deal if they have to hand spread financials. It's not worth it. But if they can automate it all, then you're going to have a buyer base that has never existed for smaller issuers that will buy everything out there. And so I think that's what needs to be brought down from advisors and bond counsel is, yes, it may be painful, but the more information is out there, the cheaper your borrowing costs will be over the long run.
We as investors, we don't help. Okay, I mean, to be honest with you, like I've been in the room, there's a cacophony of interest, right? Everybody wants something different. I want a vanilla, I want chocolate, I want a Schedule A, I want this. Can you put it in this format? Like I do think a little more organization in the request from the investor community would be helpful. But this goes out on like understanding, like at the center of this, there's a client that is not incented to take on change, but for whom there's a value to do so. And coaching them to how to do that and make it digestible is critical.
Yeah.
Just let me jump in because there's a couple of questions here on tax loss harvesting. One is how much of a time commitment is tax loss harvesting for an SMA? The other one is there opportunity to pivot the retail space to emphasize performance in addition to tax efficiency? So it's all
Yeah,
you. Yeah, it's all you.
Yeah, so I mean, like the tax loss harvesting, the numbers, I would say, if you look at the overall business cycle, it's pretty low compared to equities. It's still like 25 to 50 basis points. We have kind of automated the whole tax loss harvesting, but we've done it with guardrails, right? So because nobody wants to harvest $100 loss in Muni bonds because it's not worth it. Like the slippage and like, the turnaround cost, will eat that away. So I think what we have done is we have tried to automate the whole thing. And my view is there is a ton of education that needs to happen in this space for people to understand, that it is at the end of the day, it's an overlay, right? It's not going to change the overall performance of your strategy, whatever that might be, a ladder or a active portfolio. I think I agree with you. Performance I've seen in the financial advisory communities like tertiary, secondary or tertiary, they look at the brand, they look at your ecosystem. Performance is not seen as a metric that is used for selecting managers. I haven't, I mean, again, coming from the hedge fund world, that was a surprise to me. I think we need to do a better job in highlighting that and educating the advisor community. And to your point earlier, I think the advisor community sees change as a threat rather than an opportunity. So standardizing this, focusing on education, making sure that they understand that tax management or tax overlay is an added alpha. It's not the only alpha because I've seen folks talk about tax alpha as the only alpha. That's not true. You still have to outperform or perform in your existing underlying strategy. So yeah.
And I think too many RIAs view munis as they don't care about their performance. It's just don't screw it up. We'll make our money on the alts. We'll make it on
Right.
equities. Just don't screw it up. When '08 happens, I just want to have my money still there. That's all I care about. I mean, I got told by numerous RAs, if you outperform in a bull market, I don't care. I want you to outperform in the bear market.
Mhm.
And that's all it is safety of principle. And
Right.
that mentality I think can shift over time, that it's just another asset class like
Right.
anything else that you analyze on performance and risk and all the other things.
There's two other questions that are somewhat related. I know we're going to run tight on time, but they're too good to pass up. One is to what degree can discretion and intuition be modeled and automated? And the other one is as more asset managers will adopt technology to automate investment processes, what would differentiate one from the other, and then what would be their value add? And you can see why I see the relationship between the two. I mean, if I'm an asset manager and I can model in discretion and intuition, I think I have a differentiation. The other part is for asset managers that cannot differentiate, either they're going to find other opportunities to pursue, or they may just get merged. There's no reason we have to have the number of asset managers out there we have now, and there may well be an ongoing consolidation through merger and acquisition with that. But in other words, what does the panel think?
Yeah, I mean, listen, the asset management industry is definitely going through a conundrum, right? The revenues have kind of stalled, the costs have increased. So, even the slowdown we saw in 22 and the recovery in 23, it was like, we didn't really see the recovery in the revenue base. The assets recovered. So to me, I think consolidation is going to happen. I was joking to one of my ex-CEOs that 1 out of 5 asset managers will go out of business. He laughed and he said 1 out of 2 will go out of business in the next 5 to 10 years. I think it's going to be tricky because the big are getting bigger. If you look at the top 5 asset managers across all of these asset classes, in multi-asset and passives, 80% of the net flows goes to top 5 asset managers. Active equities, 50% goes to top 5. Active fixed income, 37 or 40% goes to top 5. And privates is actually one area, only 14% goes to top 5. So I think there are opportunities. So everybody is pivoting to wealth, everybody is pivoting to alts, SMAs, ETFs. So I think that pivot, whoever does that more cost efficiently will probably survive, but you need scale. I think scale is going to be the key in my view, right? If you're not at scale and you can't differentiate, you're going to perish.
The previous question, the modeling intuition and bias, or modeling intuition and discretion, I think it was. Um, until the market gets to a place where there's a demand for absolute return or demand for you know, something other than the beta of the marketplace, there's not a lot of value to that. Because you're not, what, you know, you think about it with other hedge funds, like when we're involved in a trade that overlaps in the corporate space, we're very fixated, for example, on, like we might have a big taxable muni corporate basis trade on. We're very fixated on what's the hedge fund community doing in the corporate space?
Mhm.
What's their long tilt?
Wow.
Like, how many, what's the hedge fund like? What's the hedge fund net leverage to corporate exposure? Like that reflects bias, it reflects discretion. But that's because we're trying to solve for an absolute return. That data set isn't really interesting if you're not trying to get an ultimate return. I gotta ask this last question though.
All right, well, I was told we have like 15
The
seconds.
dealers should pool all their stuff in a blind pool and get rewarded for that. To create a pre-price price transparency blind pool mechanism. That would really be smart in the block marketplace. No one wants to do it because everybody thinks they have their proprietary pricing. It's bullshit.
Good, great.
What do you
ending.
think,
I got to
Hector?
stop there. I mean, come on. Everyone wants to know what the next chapter of that is. Well, that's what the happy hour is for, I think. All right, this is great. A round of applause for everybody. Thank you. You guys did a great job. Thank you.